What's going on, you guys, and welcome back to the Aray Show. So in today's video, I'm going to be showing you guys a step-by-step process that I use to determine what dividend stock should be inside of my dividend portfolio. So I'll be showing you guys a bunch of different scenarios if you're younger and looking to build wealth, or if you're older and closer to retirement. So if you guys want to see that, stay tuned and cue that intro. So first things first, before you even think about deciding what stocks to invest into, you have to identify your strategy. So do you want passive income right now, or are you looking to build long-term wealth? So those are the two basic strategies I'm going to be going over in this video. So basically, if you want to have a long-term growth for dividends, you want to focus more on a smaller dividend yield, but with higher growth potential. And on the other side, if you want passive income right now, you want a higher dividend yield, but stocks that are a lot more reliable and have been continuing to pay out this dividend for a long term. So I'm going to be going over both of those scenarios in more detail in this video, but the first thing that you want to do is identify a strategy and know your time horizon. So let me give you guys an example. So if you're a long-term investor, Apple's a perfect prototype stock that you'd want to own inside of your portfolio. And the reason why is because it has tons of growth. So if you look at it in the last 5 years, it's been going up about 460%, which is huge. But unfortunately, there's a trade-off with growth stocks in the dividend field. So what happens is, although these companies grow like crazy, their dividend is pretty small. So Apple pays about 22 cents per share every single quarter, which isn't a whole lot. But the thing is, they be growing their dividend all the time, every single year, by a pretty big amount. So that's one of the best things about Apple and other growth dividend stocks is we have tons of time as a long-term investor. So if we invest into Apple now, we'll get a lot of capital appreciation and our dividend will grow at the same time by a lot of amount. So just this year, and I think recently last week or so, Apple grew their dividend by about 7.5%, which is a lot in compared to some of the other stocks that we're going to be talking about later in the video. But that's kind of what you want. You want capital appreciation and you want high dividend growth as a long-term investor. So just to put that in perspective, you can see this is Apple's dividend growth, and all it does is it goes up and goes to the right. And that's exactly what you want to see in a company that's growing their dividend. So in 2012 and 2011, it was at about 19 cents per share every single year, and that's been growing steadily all the way up until 81 cents per share in 2019. And like I said last week, they just upgraded that to about 88 cents per share every single year. So that's huge, going all the way from 19 cents to 88 cents in a matter of almost not even 10 years. So that's exactly what you're going to be looking for as a dividend long-term investor. And also at the same time, another way to kind of think about it is you're basically getting this raise every single year. Like, tell me a job that you get in average on the last 5 years, almost a 10% raise every single year. That's kind of insane to think about, and that's exactly what you're looking for in a long-term dividend company. Alright, so let me show you guys something really cool with long-term dividend investing. So we're going to be looking at the yield on cost of Apple. So if you don't know what yield on cost is, it's basically just the dividend yield if you had bought it back in time at a different certain price. So that's just the yield on cost. So if you had bought it today, you'd be getting about 0.67% as the dividend yield, which isn't a whole lot, but like I said before, Apple tends to grow their dividend and they also grow their stock over time a lot more than some of the other stocks. But if you had bought it 5 years ago, you'd be getting about 3.79% dividend yield. And that's basically in comparison and can compete with a lot of the passive income stocks, dividend stocks right now. So if you had bought it 5 years ago, you'd be chilling with almost a 4% dividend yield, which is huge. But if you had bought it 5 years or 10 years ago, or even longer, you would have got so much more dividend yield. You'd got almost 7.45%, which is better than AT&T right now. And on top of that, Apple keeps growing their dividend yield by 7 to 9 to 10% every single year. So you can only imagine where this can go. It only goes up and to the right in a certain way. So that's the cool thing about investing into long-term dividend stocks is they have a lot of growth potential as compared to some of the stocks if you're looking for passive income. So we looked at dividend stocks in the long term. Now let's kind of look at stocks that you'd want to look for in the short term and how they're constructed. Alright, so the next stock up we have is Coca-Cola, and in my opinion, this is a great stock to have if you're looking to retire or if you just want some passive income right now. And by the way, guys, this isn't financial advice. I'm not a financial advisor or anything like that. This is just my opinion, and these are just examples. And I do own these stocks, so just disclaimer. But anyways, this stock, in my opinion, is great, and the reason why is the dividend is at a 3% dividend yield, which is pretty good. but there also is a little bit of a trade-off. So in comparison to Apple, Apple grew 460%. Coca-Cola only grew about 17%, and that's because of the pandemic, so where there was a giant dip. So on average, it probably won't grow as much as Apple did, or in that much in total. So if you go back to the 5 year, it only grew about 20%. So that's kind of the trade-off with dividend stocks that are for growth and dividend stocks that are for passive income. So as you can see, Apple grows a lot higher and faster than Coca-Cola does, but the dividend is smaller, and vice versa for Coca-Cola. So the dividend is a lot larger, but the growth potential in terms of the stock and capital appreciation isn't there. So if you're looking to retire, if you just want passive income, Coca-Cola is great because they have a nice dividend yield. And also, one thing to be careful of is not chasing the dividend yield. And I'll leave a link up here. I left a video where I talked about mistakes that dividend growth investors make, so I'll leave that here. But you don't want to be too fixated on the dividend yield just because, sometimes the company's not great. So what you want to be looking for in a company that has a high dividend yield is how reliable it is. And Coca-Cola is a perfect fit for that. So we're going to be looking at the dividend history for Coca-Cola, and as you can see, they started quite some time ago, and ever since then they've been paying a dividend every single quarter and every single year. Meanwhile, going through recessions and pandemics and increasing their dividend year after year. And this is exactly what you want to look for, a reliable company with a high dividend yield, and that's perfect if you're looking for passive income or if you're looking to retire. Another thing to look at is the yield on cost. So as you can see, currently you'd get about 3.8% dividend yield, and 5 years ago you would have got about 3.71%. So as you can see, it doesn't grow as fast as Apple, but it's keeping up with inflation and it's still growing year after year. So it's something that will be able to be sustainable for you if you're looking to retire, or if you just want a reasonable and reliable income every single year. So that's a great thing about stocks like Coca-Cola. Even though they don't grow as high, they're a lot more reliable and they keep up with inflation and they're consistent. So the next thing that I look for is a little bit more conceptual and harder to see and find than it is, for example, finding out dividend yields and all that. All that information is all up on Seeking Alpha and other websites, but this one you're going to have to dig a little bit deeper. And that's that you want to figure out a company's strategy, their product and service, their moat, and their industry. So it is a little bit more deeper and a lot more harder to figure it out. I mean, you can invest just based off of dividends and stuff like that, but it's also important, in my opinion, to figure out what type of company you're investing into just because you want to see if they have a future or not. So we're going to be using Apple just because it's the easiest example to use. So in my opinion, I think Apple's strategy is amazing. I don't think that there's going to be some other new type of destructive innovation that will take them out of the game. Apple has tons of money on the side. Their company just keeps on creating new ways to get more money. For example, they keep creating new and new services, new subscription models, and even new products. So that's why I think Apple is going to be here for the long term and it's going to stay. So I like their strategy. I like their product and service. I don't think any company can beat them down or take them away. So they have that moat, and they're in an industry that everyone needs, the phone industry, entertainment industry, and pretty much anything to do with that. And I don't think that industry is going down. So if we compare that to an industry that's kind of on the decline, and I made a video on it, so I'll link it up here, and that's the oil or energy industry. So in my opinion, I think that clean energy is going to eventually take over. So if you're a long-term investor, you probably don't want to go towards long-term energy companies. But if you're the short-term investor and you like their dividends, then yeah, why not? But if you're looking for the long term, then that industry is kind of dying out. So you don't want to really focus too much on that. So that's just one thing to look at. It's a little bit more conceptual and hard to find, but in my opinion, it's really important to understand your company, their services, and their products. So another thing to keep in mind when building your dividend portfolio is you kind of want to know what companies are going to be your core companies and what companies are going to be the supplementers. So what I mean by this is you're going to have a certain amount of companies that you're never going to want to sell no matter what happens. And then you're going to have a smaller percentage of other companies that are going to be there to supplement the other companies if things go wrong, or if you need to sell some companies, it's going to be the supplementary companies. So let me give you guys a quick example of that. So we're going to hop into my tech sector, and we're going to see that Apple and Microsoft are worth almost 50% of my entire portfolio. These two are my core holdings, and I don't plan to sell them anytime soon. And the reason for that is I believe in them in the long term, and they have great companies, and their dividends grow a lot more than some of the other companies. Then now I've got Texas Instruments and Cisco at a lot smaller of a percentage. And the reason why is these are here to kind of supplement Apple and Microsoft. They have a higher dividend, but their companies don't grow as fast as Apple and Microsoft. So if things go wrong and I need to change up my portfolio, these two are here to supplement Apple and Microsoft. And if I need to sell, these companies are here to do so. So I'm not telling you should sell, but I'm just saying that you should have a little bit of diversity inside your portfolio. So if you're looking to retire, and you have some Coca-Cola, you have some AT&T, you have some Verizon, you have your higher dividend yield stocks, you should also have a little bit of Apple where you can kind of just cash park your money and get a little bit growth over time. So it's just a good thing to have in your portfolio. You should be able to allocate your percentages however you like and be able to make it work for you. So in my case, I like to have a lot of higher dividend growth stocks like Apple and Microsoft, and have a few supplemental companies with very high dividends like Cisco and Texas Instruments. So that's just kind of the way I like to structure my portfolio, and I think it's going to be a great way to build your portfolio. All right, so the next part is a little bit more advanced and complicated, so hopefully I'll be able to make a future video of this in the future. So if you guys want to see that, stay tuned and hit the subscribe button so you can stick along and wait for that video. It would mean a lot to me if you guys could do that. I'd much appreciate that. But anyways, back to the video. I'm just going to highlight a few things that I think are very important to look for in a company. So obviously you want their revenues to grow and their gross profit to grow over time. And the reason for that is you just want to see growth in a company, because that just means that they're going to grow more as a company, get you more dividends and also capital appreciation. Another thing that I look for is I also want this company not to be in too much debt. So you can see that the debt is very low for Apple, and Apple's a great company. So it's going to be a little bit out there when it comes to looking at some of the other companies. Some of the other companies might have a little bit more debt, but they manage it a lot better than other companies do. So for example, AT&T has a lot of debt and they haven't been managing it very well, but recently with their new management, they've been doing pretty well. So these are just some things to kind of pay attention to. You really don't 100% necessarily need to, but it's important to know all these different types of things. Another thing to look at is payout ratio. So what this means is how much of their money is Apple using to pay you in dividends. So it's only about 17%, and that's very, very low. And that's great news if you're a long-term dividend investor in the Apple stock, because that means that they can pay you out even more than they do right now, which just means they're not necessarily going to pay you right now, but this means that they have a lot more room to grow in terms of giving you out that dividend. So over the next few years, the amount of dividends you'll be receiving is going to be a lot larger than it is right now. And they have such a huge amount that they can potentially increase their dividend, which is something that you want to see as an investor in their stock. But now if we take a look at Coca-Cola, you can see the payout ratio is much higher at 77.10%, which kind of makes sense because that's why they're not increasing their dividend as much as Apple is. And it kind of sucks because there are trade-offs between stocks, but you got to remember that they've been paying out their dividend for 58 years while growing it every single year. So you got to remember that Coca-Cola has been in the business for that long, and they're a household name, so they probably won't go anywhere, and they'll be able to manage this payout ratio. Although it is very high, they should be fine. So nonetheless, you can kind of see the differences between long-term growth stocks and current passive income stocks. So with that being said, that's pretty much it for the things I look for and the processes I go through to identify stocks to add to my dividend portfolio. So with that being said, that's pretty much all I have for you guys for today. I'll leave my portfolio in a link in the description below if you guys want to kind of get an idea of what a portfolio would look if you're looking to retire between 25 to 30 years. So I'll leave my link in the description. With that being said, guys, I appreciate you guys for watching my video. If you guys found any value or if you like this content, please leave a like, comment, and subscribe. It would mean a lot to me. Honestly, it really does. So I appreciate y'all. And with that being said, that's it, guys. And remember, everybody eats.